All right, we're going to do exercise 17-6, and this one presents the problem of having two temporary differences in it. As you can see on here, the depreciation expense for book purposes is $70,000, and the depreciation expense for tax purposes is $100,000. So our depreciation difference, delta being the difference, is $30,000, and our tax rate is 35% this time. So that will be $10,500. And because the tax expense is greater, that lowers our income, and we'll be paying less taxes than our tax expense would be for book. That will be a deferred tax liability. So we go ahead and put that in a T account. And then we also have a warranty difference. The estimated warranty cost for book purposes is $30,000, which we accrue. But remember, for tax purposes, we can only take our actual warranty costs, and those are $10,000. So there's a $20,000 difference. The warranty difference is $20,000. And again, our tax rate is 35% in this problem, so that will be $7,000. So this creates a deferred tax asset. All right. So now we need to calculate, they've already calculated our taxes payable of $38,500, but we need to calculate our tax expense for book purposes, which will be the $120,000 in income times the 35% tax rate, and that will be $42,000. So now our journal entry on this will be tax expense deferred tax asset that's $7,000. Deferred tax liability $10,500, leaving us with taxes payable, which is given to us as $38,500. So we've got $49,000 on the credit side, $49,000 on the debit side, and so our journal entry balances. So that's good. And then it says, are there any differences between the federal income tax rate and Fortune's effective tax rate? And the answer here is no, there is not. Where the effective tax rate and the federal tax rate differences come in is when there are permanent differences. Temporary differences always resolve, and so that rate will be the 35%. Now, an interesting thing I want to point out here before we leave this problem is, despite the fact that we have a deferred tax asset and a deferred tax liability, on our balance sheet, we net those, and in this case, we'll only report the difference of a deferred tax liability of $3,500. So when you have both deferred tax assets and deferred tax liabilities, the balance sheet only shows the net effect of that. All right. So that finishes exercise 17-6.